Hello, welcome to our noontime webinar. I am Dr. Jill Brooks, Director of Education for First Healthcare Compliance. At First Healthcare Compliance, we're here to help you with a comprehensive compliance management solution tailored to your business, be it a hospital, hospital network, healthcare practice of any size, billing company, or skilled nursing facility. For these webinars, we bring experts in from around the country to cover a variety of compliance topics. We are so pleased to have Richard Chasinoff of Veralon today for his presentation on Fair Market Value Primer. Rich has more than 20 years of healthcare experience, including extensive experience in healthcare valuation and executive leadership experience in hospital operations, business development, and planning. He has worked with community-based hospitals and health systems of all sizes, as well as teaching hospitals and for-profit health systems. His experience includes valuation of physician practices and various physician entities, as well as hospitals, imaging centers, urgent care centers, and others, compensation valuation for employment, practice management arrangements, practice and equity partner management agreements, and equipment arrangements, physician compensation design, including development of incentives, and imaging improvement strategies for hospitals, including acquisition assessments. Prior to joining Veralon, Rich served as Senior Director for a national consulting firm specializing in healthcare valuation. He also served in executive leadership roles, including Vice President for Clinical and Diagnostic Services and Vice President for Planning at two not-for-profit community hospitals in the Northeast. He has had operating responsibilities for hospital programs including radiology, oncology, diagnostic cardiology, neurology, and stroke, and hospitalist and intensivist programs, and was Administrative Director for a Department of Medicine. Rich is a member of the National Association of Certified Valuators and Analysts, from which he holds the designation of Certified Valuation Analyst, CVA. He holds an MHA and MBA from the University of Minnesota and a BS in Biological Sciences from Cornell University. Before we begin, feel free to download the PDF of the slides in the handout section of your control panel. If you have any questions during the presentation, there will be a contact slide at the end that you will be able to email Richard directly, or you can always contact us with your questions. Your CEU certificate will be sent to you within 24 hours. Thank you so much, and Rich, go ahead.
Terrific. Well, thank you, Dr. Brooks, and thank you to the entire team at First Healthcare Compliance for supporting this webinar and so many others. This webinar is focused on fair market value, and the title demystifying is really demystifying fair market value is really an attempt to say that we valuators spend a lot of time talking in code, and we work so closely so often with compliance professionals across the country, and we acknowledge that sometimes our code and our language gets ahead of us. So my hope is with this discussion that we can make some of that clearer and help you work more closely with those independent consultants that you use in this arena to help you ask the right questions and understand the work that they're doing just a little bit better. The path for our presentation today will start with the regulatory framework, which I know so many of you are plugged into each and every day. We'll talk about fair market value, commercial reasonableness, the activity around these issues and some of the implications. But most of our time is going to be spent on healthcare valuation and how we determine fair market value in healthcare. We'll talk about the underpinnings, and we'll talk about each of the three primary approaches that valuators use, and then we'll talk a little bit about the interplay between the business side and the compensation side, and then hopefully we'll wrap it all up in a nice, neat package at the end. So we'll start with the regulatory framework, and these are probably terms that you've seen before. The Stark Law, Anti-Kickback Statute, and Private Annulment, and they really to define the work. Each of them requires the transactions between physicians and other healthcare entities be consistent with fair market value. Stark has civil penalties, as you know, kickback, civil and criminal penalties. Private endowment is an IRS structure, and organizations not-for-profit status is potentially on the line. And I know that many of you are familiar with each of these regulatory aspects. So what I wanted to do was, since these three regulations and regulatory constructs all point to fair market value, I thought it would be important to start with a definition of fair market value. And fair market value is defined not only in healthcare, but defined in the valuation field, whether it's healthcare or any other industry. And this is the definition that comes out of the valuation literature. It talks about, there are a couple of key concepts highlighted in blue here, but the price in cash at which property would exchange hands between a hypothetical buyer and a hypothetical seller. So this word hypothetical becomes critical, and we'll talk more about that in a second. Acting in an arm's length transaction. In an unrestricted market, neither has a compulsion to buy or sell, and both have knowledge of the facts. So there is a very specific definition, and you may have heard bits and pieces of this as you've worked with valuators in the past. What you don't see in here is the referral concept, because that comes in on our next slide from the Stark regulations. And the Stark regulations point to fair market value, but go just a step further, and they say that it's a result of a bona fide bargaining arrangement between well-informed buyers and sellers. So those are the same concepts that we discussed previously, but here's where it specifically says it's buyers and sellers who are not otherwise in a position to generate business for the other party. And that's where this concept, and you've probably heard before, without consideration of the volume or value of the referrals. And that's where valuators spend a lot of their time and really work as we try to develop fair market value opinions, really work hard to tease out and separate the volume or value of referrals from the opinions. And I can tell you that I've been in a position to have reviewed the work of other valuators, and I've seen valuation reports that were brilliantly done by valuators who weren't familiar with healthcare and the unique aspects of healthcare. And what you see when they conduct evaluation is you see the focus here. And I have seen in instances where they have missed that Stark definition about volume or value of referrals, and it created a perfectly by the book valuation report that was not valid or credible in the healthcare environment. So it really is important to focus not only on the industry definition, but on the Stark definition as well. We talked before about hypothetical buyers and hypothetical sellers, and there's this question of, you know, how hypothetical can you get? Because it is important, the hypothetical aspect is important, that physicians should not have a name, that organization. It's not about the name or relationship that can be created. However, it is important to have hypothetical with the same or similar characteristics. So if you're valuing a business, you can't say, well, our hypothetical imaging center might be a $40 million business, whereas our imaging center is a $5 million business. You can't say a hypothetical physician with 25 years of experience when our target physician has only 3 years of experience. So it is important, as we think about this concept of hypothetical, it's hypothetical, but within certain same or similar characteristics is important as we think about the valuation concept. I also wanted to raise here, and this is the only slide on this topic, the concept of commercial reasonableness, because the Stark law requires, and the regulatory framework requires, not only that arrangements be consistent with fair market value, but that they also be commercially reasonable. And what the definition is here, it says that arrangements are considered commercially reasonable in the absence of referrals, there it is again, and if it would make commercial sense if entered into a reasonable entity of similar type and size and a reasonable physician of similar scope and specialty, even if there were no referrals between the parties. So there's this question of what is the value, what are the services worth? But what commercial reasonableness asks is, should we be paying for those services in the first place? So I put together 3 examples here, and they are not de facto not commercially reasonable, but it's just the kind of arrangement that causes a evaluator to step back and say, does this make sense? Does this make commercial sense? If there were 3 medical directors for a cardiology program, perhaps that makes sense. Perhaps there's a medical director for interventional, a medical director for diagnostic, and perhaps a medical director, an overall medical director. Maybe that makes sense. Maybe that makes sense in a large organization. Maybe it doesn't make sense in a smaller organization. So we would be looking at the various duties of the medical directors. How many hours are required? What is going on there? And does this make commercial sense? Our second example, payment for administrative that really aren't needed. Of course, we should be paying for services that are needed, or renting space when you don't actually need space. When we think of fair market value, we're always thinking of, is it fair market value and is it commercially reasonable? And we think about those 2 together. As you work with evaluators going forward, I'd encourage you to ask the question, are you thinking about commercial reasonableness? Does your opinion also contemplate and also include a commercial reasonableness opinion? Because the 2 really, they're separable, but they're also inseparable at the same time. And the rest of our presentation is going to focus on fair market value. Why is this important? Because there's been a lot of enforcement activity. There's still arrangements which are suspect and are being looked at very, very closely. $1.9 billion was recovered in 2015, 16.5 billion since 2009. Large settlements, which you've probably heard of in other contexts, the DaVita settlements, $450 million for unnecessary administration of medicines, another $350 million for payments to physicians to induce referrals, the Adventist settlement for $115 million, the North Broward settlement for $69.5 million. These are large numbers and have great impact and effect on their organizations. And why go after this? Why do this? One observation is that between 2011 and 2013, there was $8.10 recovered for every dollar spent on recovery. That's 710% return on investment. And it's only logical that the government would make this investment. Why is it happening? There is an increase in enforcement. There are a lot of key TAM suits. They're focused on compensation arrangements. For many reasons, because those compensation arrangements are ongoing. They happen year over year over year, as opposed to one-time arrangements. There have been difficulties with fair market value and commercial reasonableness. There have been issues identified with bonus methodologies, with the way group practices are structured, and whether the compensation arrangement is meeting the requirements under a group practice, the group practice exception under Stark. And the other thing that we're learning is that the simple presence of evaluation is not a guarantee of safety. And evidence the 2013 settlement with Toomey, there was evaluation in that case, and regardless, there was still a payment made and still found problematic. So what are the implications as you think about evaluators? You want evaluators who are not just going to produce a report, but you want somebody who's independent. Independent is important. That's been particularly helpful for all of us, without a doubt. But many organizations are trying to do this inside, and there's always this question of whether or not they are fair and impartial. The ability to be independent, even coming to the same conclusion, is important in working with evaluators. You want somebody who works in healthcare because the rules are specific and different in healthcare. You should expect your evaluator to ask a lot of questions, and we'll talk about that a little bit later. We should understand the arrangement, its rationale, why are you doing it, and you want to keep the evaluator abreast of changes as you move forward. Evaluators are looking for atypical deal features that we're looking for. We're sort of looking for the needle in the haystack sometimes, and we know that everybody is trying to do the right thing, but sometimes the momentum of a transaction leads to discussions and takes you down a path that you need to pull back a little bit. And I know that each of you have been involved in those situations, and that's what independent evaluators who are looking at the whole thing can help identify. And finally, bad facts make bad valuation. It really is all about the facts. It really is all about the understanding. And if when you're working with evaluators and everybody being on the same page really helps. So with that, I want to talk specifically about valuation and how evaluators go about determining fair market value for a particular arrangement or a particular business. So these four key underpinnings are really important to us, and they are among the first questions that we're going to ask. We may not ask them what is the subject, what is the standard, what is the premise, but we are going to seek to understand the answer to these questions so that we can determine fair market value. The first thing is, greatest, highest level importance in valuation is understanding what you're valuing. What are the services? What do they include? What don't they include? Who's providing them? If it's an entity being valued, we ask the question, is this a 100% interest or is this a 10% interest? Because the valuation approaches and assumptions differ. The standard of value is also important. We're focused here on fair market value, and that's usually what we see in healthcare. And I want to distinguish that from investment value, which is one of the other standards. Fair market value is the independent standard. It's the hypothetical standard. Investment value gets more specific. And one way I like to think about that, I actually like a real estate example in thinking about investment value versus fair market value. We're all used to, as we purchased homes, for those of you who have, went through an appraisal process and got a fair market value or fair value standard on the house. However, if you were in a scenario where the two houses on either side of yours were owned by a particular buyer, and the buyer was particularly interested in that property in the middle, that buyer may be interested in purchasing that at a higher price than you are willing to pay at fair market value. And that becomes an example of investment value. Investment value speaks to what can I do with this property once I acquire it, which is a little bit different from what is it worth in the marketplace generally. So we are focused here, of course, on fair market value. The other underpinning is the premise. Typically, we're focused on a going concern, but things have a different value if you're trying to liquidate them, particularly with a business. If you're having the proverbial going out of business sale, the value of that business is much lower than if the business intends to operate as a going concern on into the future. So we want to understand what's going on and what the premise is. And finally, the date of the valuation is also important. As of what date would you like the opinion to reflect? And we want to reflect facts known or knowable as of that date. Various arrangements that we're focused on, and we'll talk about both sides of this coin today. And I've already alluded to some of this. There's business valuation, which is the sale of an entity, usually a one-time. It's purchased to change its hands, whether that's 49% or 10% or 100%. But the value, the property literally changes from one ownership to another ownership, and that can be imaging centers, cancer centers, or urgent care centers are common, but there are many more. And then, of course, physician practices. Compensation valuation is the other side of this coin. And compensation valuation is more typically ongoing service arrangements. A lot of different arrangement types here. Employment, medical director, subsidies all fall into this arrangement type. And then, of course, you have what I call hybrid arrangements, where there's a valuation of a business and subsequent compensation. Sometimes we see this, I'm thinking of a physical therapy practice that perhaps is purchased by a hospital, and then the former owner of the physical therapy practice enters into a management agreement to manage the physical therapy practice that he once and formerly owned. That is the hybrid example. Or a hybrid is a physician practice where the physician sells his practice to the hospital and then subsequently employs the physician. And there's a relationship that needs to be drawn between the two, and we'll talk a little bit about that. There are three valuation approaches that valuators look to. There are many different methodologies within each of these approaches, but we put each of these three out here. And if you've worked with valuators before, you know, you've heard us quickly and without much thought, it's very ingrained, refer to the market approach, the cost approach, and the income approach. And we'll talk about each of these. For now, let's just say that evaluators should be considering each of these approaches. You want to think about each. They each have advantages and disadvantages in specific situations. So it would be wrong to say we always do a cost approach, or we only do a cost approach, or we only do a market approach. But then the question is, if one is particularly disadvantageous or not reliable in a particular instance, only after considering it should it be dismissed, and it may not be used in the final valuation opinion. So what we'll do over the next few slides is begin to talk about each of these approaches. The market approach first, and the market approach is based on observations in the marketplace. And one of the best examples I can give you actually is not a healthcare one. It's what is the cost of a car, and because we all know the answer to that question in our heads, and many of you are saying it depends, and we'll focus on that in a second. But that's the same question. So as we move to healthcare, what are the multiples, which is a common term we've heard? What multiples are imaging centers transacting, or what is the hourly rate for cardiology medical directors? So these are all questions that we can begin to answer with the market approach. And the key is, and I'm going to come back to our car example, the key is identifying a comparable, not just any comparable, but one that actually makes sense to use. So when I say, what is the price of a car in the marketplace, your next questions are, well, is it new or used? Is it big or small? Does it have bells or whistles? Is it a luxury brand or not? What features does it have? You want to answer all of those questions in order to understand. It's not a fair question to simply ask, what is the price of a car? You have to understand what kind of car. So let's quickly translate that to the value of healthcare businesses. When somebody says to me, what is the price of an imaging center? I have the same questions that I have about cars. Is it a big imaging center or a small imaging center? Translation, what is its revenue size? How many modalities does it have? Which ones? How much volume does it put through? Tell me more about this center. Tell me about its profitability. So we need to understand these questions, and only then, using a market approach, can we ask, what do similar businesses sell for? So we want to find imaging centers. If we're talking about multiples for transactions, we want to understand what are the multiples that similar businesses have? And that's why we want to understand them. And if you've ever talked to an evaluator, we are always very slow to throw out those rule of thumb multiples, X times EBITDA or Y times revenue, that many hear in the industry from say brokers or from others who are in the business of trying to buy or sell these centers. With respect to service arrangements, we again want to find similar businesses. We want to understand, if we're asking what the value of a medical director is, we need to understand what similar medical directors are being paid. Similar amounts of time. Physician has similar backgrounds, same specialty. So we want to begin to understand things. And for employment, and those of you who have participated in employment agreements, employing physicians, you know that there's a discussion of the production being consistent with compensation. That is, that a 50th percentile producer probably should earn around the 50th percentile, and a 90th percentile producer perhaps can earn at the 90th percentile, though there is some additional complexity to that as well. So what I wanted to talk about on the left side, we'll talk about some features of the market approach that as applicable to business valuation. On the right side, we'll talk about compensation valuation. But for the market approach, we want to gather, as related to businesses, we want to gather market data. We want to understand what those multiples of EBITDA and multiples of revenue actually were. We can learn that from private transaction databases. There are systems that we have access to that record various transactions. The key is getting enough of them to actually make a reasonable judgment or reasonable decision. We can also look to publicly traded companies, though we acknowledge that there's usually a size difference there. Our company may be $10 million, and the publicly traded company may be in excess of $1 billion. And how do you connect the two? So the challenges in doing this is matching the size and scope. We want to match. We want to create and understand organizations of similar size and scope. We want to match the outlook for those businesses. Was one in a particularly competitive area, whereas perhaps another was in an uncompetitive area. So we want to match the future outlook, and we want to separate reliable data from unreliable. It's very challenging to understand which data points and from which sources you trust the data, and from which the data may not fit or work with the valuation methodology. Very similar story on the compensation side, on the right side of this slide. Again, we're relying on market data. There are a lot of published surveys reporting annual compensation and hourly rates for various physician specialties. We've looked at our own research, we've talked to and understand what's going on in the market. But again, the challenging is matching. It's matching the services, matching the quality, matching the capabilities, and teasing out the noise in the survey data. As you look at survey data, sometimes you see some difficulty. For example, when you look at the compensation paid to say medical oncologists, understanding whether that data has infusion revenue embedded in it. And so we try to tease out from the market data what we're seeing. A few examples. This first example using a market approach is employment, and we lay out for you a hypothetical specialty. We lay out various percentiles of data down the left side, 25th through 90th, and you can see the compensation grows. The 25th percentile compensation is $386,000, and the 90th percentile compensation is $798,000. We see the same for work RVUs and collections. We array compensation per work RVU and some other data as well. So a few things we're trying to think about. I had mentioned that there's a matching. Ideally, median producers would earn median compensation. But let's take a look at the this hypothetical physician down on the last line who produces 9,500 work RVUs. Well, that's approaching the 75th percentile. Perhaps this physician should earn 75th percentile compensation. But take a look at the collections of 600,000. That's more 25th, more closely aligned with the 25th percentile of collections. So how do we begin to use these various data to align? And we want to understand, and the evaluators are trying to align these data, thinking about the impact of collections, thinking about the work RVUs, thinking about how a particular physician's compensation to collections ratio should line up with the benchmark data. And we're trying to triangulate using all of this market data to develop the best opinion of fair market value that we can. A few thoughts. You know, what should the impact of collections be? That's a discussion that we have frequently in the industry. Collections are impacted by the payer mix, by the collectability of accounts, by the underlying contracts, and all of that matters. And our clients are frequently asking us, well, why does that matter if I'm going to employ them? And the collections are our problem, not theirs. We just want to focus on work RVUs. But collections strike to the underlying financial performance of the practice. So we argue that both are important. And I think that's the challenge as you work with evaluators, is to look at all of this data, not simply RVUs, not simply collections, not simply compensation per work RVU. And while we have this one slide up, I want to show you one last piece of it. And that is, there's a tremendous caution in the industry about using compensation per work RVU outside of the median. And I'll show you the way this data works. If you take compensation per work RVU at the 90th percentile, and I've had clients indicate to us, well, this is a physician who's producing at the 90th percentile, so he should earn compensation per work RVU also at the 90th percentile. But take a look here. If you take this producing at the 90th percentile of 12,100 RVUs, and you apply that to 90th percentile compensation per work RVU of $93 per work RVU, that's total compensation of $1.1 million, which is much greater than the 90th percentile. So there's a lot of nuances in the data, and it's important to understand and talk about all of the various observations that you see as you look at a complete data set. The other example I wanted to share with you was for on-call services. Our surveys, and there's benchmark data that reports, again, by percentile, 25th, median, 75th to 90th percentile data. And we might say, and we've had clients say, well, the 75th is $750, so I think that's fair. But the question is, who's earning the 75th percent and who's earning the 25th? So some things that you want to think about and that we think about in order to determine the best position within this range from, say, 300 to 900, or even lower than 300, or even greater than 900. We want to think about some of these various factors. How many physicians rotate call? What is the response time required? How often do they need to call in by phone? How often do they need to come in person? What is the payer mix? Can the physician bill and collect? All of this helps us determine where in this broad range a particular arrangement lies. So it's not, again, the key word here is identifying comparable services, not just sufficient to look at a particular data set. And that's our challenge in the market approach, is identifying services that are comparable. Let's switch gears to the cost approach. And the cost approach talks about the cost to create or replace assets or services. So it gets to this question of, what does it cost to build the car? Back to our car example. Or what is the cost of the assets of an imaging center, or the cost for a cardiology medical director? So coming back to cars, because I think that's just a nice easy way and disconnected way to think about it. What is the cost of the staff? What's the cost of the equipment, the plant, the space, the supplies, the research and development? All of these questions go into the cost of a car. So if we ask this question of a healthcare business, such as an imaging center, we want to ask the same questions. What are the costs with thinking about an imaging center? What are the costs of the staff, of the various assets they have, of the workforce in place? What are the costs associated with the assets they've assembled, the leasehold improvements made to their facility, or the equipment that they've purchased? And then with service arrangements, we also want to think about what are the costs, the underlying costs for those services. So again, focusing on business valuation on the left, identification of the assets is among the most challenging in valuing a business. We need to reclassify each asset. The book value of the equipment may be $10,000, but the economic value may be $15,000. What do I mean by that? Accountants have a defined method or methodology for depreciating things, right? You may have heard that a car depreciates over 5 years. So an accountant would put that on the books, and after 5 years or 7 years, if that were the appropriate standard, the value of that car would be zero. But everybody knows that the value of a 7-year-old car with 10,000 miles on it, if it's of a particular brand, may be worth much more than zero. So it's really identifying the economic value. What is it worth in the marketplace, as opposed to what is its book value? And we want to identify all of the assets, those that are in front of us, those tangible assets that we can touch and feel, and the intangible assets, those that you can't see, such as goodwill or the value of a trade name. And then on the right side, we talk about cost approach for compensation valuation. And again, we're looking at published surveys, which largely are the same surveys as we used for the market approach. But the challenge is accounting for all of the costs and determining whether those are reasonable. As we thought about our car example just a second ago, and we said, well, what is the cost of the plant? What is the cost of the equipment? What is the cost of the space? What is the cost of the staff? You can think about how complicated and intricate some of those analyses may be. And I think this example may begin to shed some light on this. This is a leased services example, where there's a lease of some equipment and some staff on a part-time basis. So for the equipment, we've identified the economic depreciation. We're identifying the cost for maintenance, the cost for insurance. Each of those is its own little research activity to make sure we understand those costs. And then we need to determine what the markup is. And of course, all my examples are hypothetical, but we need to determine what the markup is. In this case, we're showing 25 to 50% markup on the costs. And of course, the question is, what's that based on? Well, it's based on research. It's based on the financial statements for those companies that may be in the leasing business. So we want to understand what companies earn to provide equipment. Same thing for the staff. We want to think about the salaries, the benefit costs, and then any markup. And what's the markup intended to cover? It's intended to cover perhaps the risk for recruitment or replacement, responsibility for training, responsibility for credentialing. Those markups, we want to reflect the actual services that are tied to the particular arrangement. An organization providing staff only and saying, there they are, you deal with them, is different, or will receive a different markup from someone who provides the staff and says, we're going to run the entire HR function, we're going to cut payroll checks, we're going to supervise them, we are going to credential them, we are going to conduct their performance appraisals. So very different scope of services yields very different markups. So that's our thought process during the cost approach. And the final approach is the income approach. The income approach looks to the value of the cash flows created for the owner. So what are the cash flows generated to stick with by car companies, or in this case, or restaurants? If we're talking about imaging centers, what is the cash flow generated by the imaging center? And by logical extension, if we're talking about a compensation arrangement for, say, a medical director or an employment, what is the cash flow that may be generated by the medical director? And that there is inherently problematic, which is why you will only in very select circumstances observe that an income approach is applied to a compensation arrangement, because this applying an income approach to a compensation arrangement inherently values the referrals, which, as we discussed earlier, you can't do. So you shouldn't see an income approach applied to compensation arrangements very often. And in fact, when I commented earlier that I had read a very well done and well documented valuation report by a firm that didn't work in healthcare very often, this is exactly what they did. They conducted an income approach, and it was done exactly the way an income approach is taught in valuation schools and valuation credentialing program. However, in healthcare, and due to the various regulations that we have, you can't use the income approach in that circumstance. So we want to be wary of that. So conducting an income approach is about identifying cash flows, and identifying future cash flows. You need to think about a number of things: what's going to happen to volume, what will happen to reimbursement, to expenses, to debt payments, to working capital, and all of that needs to be considered in developing the cash flow. And then we think about how we characterize that in today's dollars, because a future cash flow, a dollar earned 5 years from now, is worth less than a dollar today. So if it's earned 5 years ago and we want it in today's dollars because the sale is going to happen today, we need to discount that. So evaluators spend a considerable amount of time in implementing an income approach, determining what the appropriate discount rate is. And it's based on financial indicators, and it's based on the riskiness of the investment. But essentially, it's asking this question: how much, if we can agree that a dollar 5 years from now is worth less than a dollar today, the key question is how much less? And that's what the evaluator is considering as they put the income approach together. So on the business valuation side, we really are focused on the financial forecast. We're trying to understand the future cash flows and develop the discount rate which we had talked about. And the challenge, of course, is forecasting the future. Some of this is challenging. We're forced to ask and answer questions of what do we think the reimbursement is going to be like? How likely are these financial forecasts going to, is it that these financial forecasts are going to materialize? And, you know, separating hypothetical from actual and what's actually going to happen. So all of those challenges on the income approach side. And of course, on the compensation side, on the right side of this slide, there's no detail because it's very rare that you'd apply an income approach in a compensation valuation. So there's an example here. It was hard to put an example on one slide for the income approach for a specific entity, but we gave it a shot. So a couple of concepts here, which you may have seen depending on the various valuation assignments that you may have looked at. We have cash flows for the first 5 years. And then, of course, you can't project into perpetuity, but the assumption is that a business will go on into perpetuity. So we also have a terminal value, which is the value that we expect to continue beyond the 5-year period. And then we discount each of these. The discount rate that we used here is 18.3%, and that's built up based on a weighted average cost of capital, which is a weighting of the equity risk and the debt risk, which includes an assessment of the inherent risks of the business. And then there are additional discounts for lack of marketability. So there's a lot of nuance here, but I think the fundamental takeaway is this idea that you're projecting future cash flows and then discounting them back to present day. So theoretically, in coming up with a final fair market value opinion, now having looked at all three approaches, theoretically, all three approaches should yield the same value. They shouldn't be different, but they often are. And then the question is to the evaluator and to those working to develop a final opinion is, why are they different? And once we understand why they're different, we can begin to reconcile them. Is there something that one particular approach doesn't take into account, or a place where one particular approach may be unreliable? And in the event that you can identify that, now you understand which approaches are better in a particular situation than others. And it's this reconciliation and pulling all three approaches together that ultimately leads to the final opinion of fair market value. And the last comment on here on this slide is as of the valuation date, and that's really an important question. If you're looking at financial statement data, for example, for an imaging center, and you have great data for 5 years, dating back from 2000 to 2005, and somebody says, well, I want to buy it today, the real question is, well, I can give you what is our projection, what is our forecast going forward, and how comfortable are we projecting based on some old data? So perhaps the valuation date is an older date, and we need to think about the as-of date based on facts known or knowable as of that date. Finally, I wanted to talk a little bit about the interplay between compensation valuation and business valuation, because I think there are some interesting nuances there. And this gets a little bit to practice valuation. So we've got a business valuation compensation, and let's use as an example the circle in the green, which is a valuation of a practice with subsequent physician employment, which puts both of these, the yellow circle of business or practice valuation alongside the compensation valuation structure. And I think one thing, this is helpful to think about. So let's talk about this practice. Fundamentally, a physician's compensation when he or she is in private practice is whatever they collect from third-party payers or in cash or however their practice is structured. They pay for their space, they pay their staff, they pay for any expenses they have in running their practice, and theoretically, whatever's left after they pay all those expenses are available to them in compensation. And what do most physicians do in this instance? When you look at most physician practices, particularly the smaller ones, they take it all in compensation. So whatever's available to them in compensation, they take out, and that becomes their compensation. That's what they and their spouse, if that's applicable, or a significant other, that's what they are thinking of as their compensation and what their earnings are each year. But the question is, if you're selling that business and the physician takes the same salary once they're employed, then how much cash is left to the owner? And the answer is there is none. So what is the value? And evaluators are wrestling with this as a very hot topic in the valuation industry. What is the value of a practice when all of the cash is distributed as compensation to the physicians? And I would say that there's a range of values. Some don't think about it that way. Some think that the answer may be zero, and some think that the answer is somewhere in the middle. But the question that they wrestle with is, if no cash is available, what is the basis to assign value to a practice? And some would say, as I said, there is no basis. And some say this assemblage of assets has an inherent value. You can't say that this collection of things, this building and space that's built out and equipment that's in place and a workforce that is trained has no value. So that's what we wrestle with, and that's what valuators are looking at. But it inherently becomes a disconnect often between what physicians think their practice is worth and what valuators determine their practice is worth. There is no doubt that there is a tremendous amount of goodwill built into practices, that there is a tremendous amount of sweat equity built into practices, particularly those that are long-standing, well-regarded practices in the community. The difference is, the challenge is that most of that value is translated to physician compensation going forward, and that's the challenge that we're wrestling with as evaluators. So just very quickly to wrap up our time together, there is a unique regulatory environment in healthcare. We definitely, it affects the valuation. It is incumbent upon valuators, or if you don't use an independent valuator, if you do it internally, but it is incumbent upon you to think about that regulatory environment. We, of course, encourage you to seek an experienced valuator, not only experienced, but qualified in healthcare, familiar with the issues, has seen these various arrangements before. You need to understand the arrangement, understand the services that are being valued. That becomes the first premise. If you don't understand the services, there's no way you can understand what they're worth. You should understand the various approaches. Use as many approaches as you can, and understand why you didn't use certain other ones. Understand the underlying assumptions and the ultimate basis for the valuation opinion. So hopefully this gave you some context for what valuators think about, and hopefully as you work with valuators going forward and think about these various arrangements, hopefully you'll have a different perspective or a unique perspective, and ask some really good questions and challenge those who are doing valuation work for you. As Dr. Brooks mentioned at the beginning, I can be reached at the contact information below. Our company is Veralon. We spend a lot of time in physician compensation and valuation, but we also have a unique context for it as we work in the strategy and planning, mergers and acquisitions, clinical transformation, value-based payment, a lot of physician-hospital alignment work that we are involved in, which puts a lot of context around the valuation work that we do. I will stop there and turn it back to Dr. Brooks.
Thank you very much, Rich. It was a great discussion. Please use his contact information on the screen to email him questions directly or call him. And if you send any questions to us, we will forward them to him as well. Please visit our website, 1sthcc.com, or to request a demo, please email us at info@1sthcc.com or call us at 888-543-4778. Thank you and have a great day.